What on earth is an open-ended investment fund?
Hi everyone, welcome back to the channel here. Hope you're all bearing up well with the coronavirus outbreak. I can report that I've lost quite a bit of money at the moment in my stocks and shares holdings, but I'm hoping that they'll rebound soon, but we'll wait and see. You'll be aware that obviously the coronavirus pandemic lockdown is having a huge impact on the economy, but rightfully so, it's quite important that we prevent the spread of the virus. So in today's video, I'm going to talk about a thing called an open-ended investment trust, sometimes called an open-ended investment fund, or just an open-ended fund. If you're watching this video, I'm going to assume that you've probably heard about that before, and that's why you've maybe searched for this and you're watching this. The most common way that folk tend to invest in stocks and shares probably would be through a broker buying stocks and shares themselves in a company they've chosen. However, if you're quite new to investing, then buying into an open-ended investment fund, which are typically available through high street banks, can be a really easy way of getting into investing, and it's something that I quite often do. Basically, what it means is that rather than you investing in a particular share, say in Marks and Spencer's for example, you can actually put your money into an open-ended investment fund, and the fund consists of a large amount of money, usually millions, hundreds of millions, or even billions of pounds in the UK, and there's a fund manager who manages the money on your behalf. So the big attraction with an open-ended investment fund compared to the old-fashioned picking your own stocks and shares is that the investment fund is managed for you. It's managed by, you hope, a professional fund manager who knows what they're doing, has the experience, and they'll use all the pooled money, so your money, along with other investors' money, put all that together, and they'll spread it across different industries, it could be blue chip companies, or it could be medium sized companies, or small companies. Sometimes you can pick if you want to be investing in Asia, or just any sort of country you would like, the UK, emerging economies, and it's great because they'll take all the money and they'll do all the decision making for you, but you can pick what sort of industry, etc. you'd like the money to go into. The other advantage to the open-ended investment fund is that you can actually start investing with as little as I think £100. So for example, HSBC, I know that you can start with as little as £100. With HSBC, it's the Global Investment Centre, and you can pick the fund that you like, and you start with £100, and you can actually pick funds if you want an income fund that'll pay you, say, a dividend, or you can pick a growth fund whereby you would leave the money in the fund for probably about at least 5 years, I would say, and let the value build up. The thing to bear in mind with income funds or any sort of high dividend paying share is that in the long run it can affect the value of the company because they're paying out the dividends. Therefore, the value of the company can sometimes reduce slightly. Something to bear in mind with income paying funds, but there's two options there. You've got the income or the growth. It's really up to you, and that's the beauty of these open-ended investment funds is you can pick, you're the boss, but it's all left to the fund manager to manage the funds and to invest it appropriately. When picking an open-ended investment fund, say through your own bank or a broker online, what to do is you can ask for the prospectus, and it's really important that you do your due diligence and read through the prospectus and see how the fund is performing in comparison to other funds, or in comparison to the stock market, and compare it, because you might see one fund has increased by say 15% in 1 year, whereas another fund has increased by 25%. So obviously you want to choose which fund, make sure that the fund that you pick is outplaying the stock market in general, and that way you're getting most returns. Now also bear in mind with the open-ended investment funds, as with everything in life, there's always fees, and it's really important that you check all the fees before you commit to a fund, and your due diligence is really important. It's also important to note that when you're putting money into an open-ended investment fund as opposed to buying your own stocks and shares, in the open-ended investment fund, the funds manager is using your money to invest. They buy the shares. So technically speaking, you don't own any shares per se. However, you own units within the fund. Now, with an open-ended fund also, you can sell back the units that you own at any time. And so if you find that you've made some money, if the value of the fund's gone up, then you'll have made some money, assuming the fees aren't ridiculous, and you can sell your units back to the fund, and they will always buy your units back. So for example, say you put in £100 today, and you find that in 3 months' time it's worth 150 quid, you can sell it back, and you're £50 up minus your fees. That's not a problem. Whereas with the stocks and shares, you have to sell them on the open market. That's where the fund is a bit easier. However, sometimes you can pay slightly more fees with an open-ended fund, so something to bear in mind. So to summarise, an open-ended fund can be simpler for someone who is new to investing, in that you just give them your money and let the fund manager invest the money on your behalf. But make sure you check the prospectus, make sure the fund manager is performing well. However, with obviously your traditional stocks and shares, you're having to go and pick the shares yourself. Quite often you're picking one share, so there's that saying, don't put all your eggs in one basket. So for example, if you pick one share and that industry drops, you've got nothing to counteract that. Whereas with the open-ended fund, if they're spreading the money across various industries, you'd hope that if one drops, then it'll be counteracted by maybe the other industry in which the fund has invested. But no, the open-ended fund's great for beginners. So guys, as always, if you have any questions, please feel free to post them in the comments section below, or you can direct message me on Instagram. If you have any questions at all, don't hesitate to get in touch. That's the whole purpose of this channel, is to help each other and help folk with understanding the world of finance. There's quite often too much complicated jargon surrounding things, and really if you break it down, it's actually quite simple to understand. Any feedback at all is appreciated, and if you want to see further videos, please feel free to subscribe to the channel, and thank you for watching this video. So I should probably say before I upload this to YouTube, when I first started out in the world of investing, and I had absolutely no idea what I was doing or where to start, and I had bought dozens of books on it, the open-ended investment fund was what I started with through my bank, HSBC. I need to say I've never regretted it. I've been fortunate enough in that it's done quite well. And like I say, the fact you can put £100 in it and just leave it, it's enough money that hopefully you can afford to, if it went wrong, you could afford to lose it. But generally speaking, these funds are competing with each other. And no big bank really wants to have a fund that's losing money. It doesn't look good for them. The other beauty with the